Hi, I'm Lee, and I'm your mileage mechanic from Cardata. Today, I'm going to walk you through one of the most misunderstood approaches to mileage reimbursement, the flat car allowance. A flat car allowance usually looks like this. A company sets a fixed amount, maybe $600 a month, and pays it through payroll. After that, the program is rarely looked at again. Simple, right? But here's the problem. In a lot of cases, over 30% of a car allowance is lost to taxes before it can ever help cover your employee's cost of driving. So while it looks simple on the surface, under the hood, it's not very efficient for you or your employees. That's where a tax-free car allowance, or TFCA, comes in. A TFCA is a car allowance structured for business driving and designed to keep payments tax-free. At its core, it's an IRS-compliant reimbursement option built around accountable plan rules. Where TFCA really stands out is how flexible it is. You can pay a fixed monthly allowance at a per mile rate or use a mix of both. The format is up to you. So how does it actually stay tax-free? This is where the key concept comes in, something called the tax test. So what's the tax test? Well, it sounds more complicated than it is, but here's how it works. Your employees track their business mileage. Then you multiply those miles by the IRS mileage rate. That gives you a tax-free limit. From there, you compare what the employee was actually reimbursed to that limit. If the reimbursement stays at or below that limit, it's completely tax-free. If it goes above, only the extra amount is taxable. This is why TFCA works so well. It solves one of the biggest issues with traditional car allowances. More money stays in employees' pockets, while employers avoid unnecessary payroll tax. You have flexibility in how you set it up, and as employees drive, more of that reimbursement stays tax-free. It's easy to understand, easy to explain, and easy to keep running without a lot of manual work. So who is TFCA a good fit for? Think of it as the most flexible option. It gives you more structure than a flat allowance, but without the rules that come with more complex programs like Favor or fixed and variable rate reimbursement. It also lets you keep a flat car allowance for roles that need it, while reducing the overall tax hit for everyone. Now, one thing to keep in mind, TFCA does come with a bit of upkeep. Employees still need to track their mileage, and you need clear documentation. That's what keeps everything compliant. The good news is, with modern tools, that part is actually pretty easy to manage. The big idea is this. A tax-free car allowance gives you flexibility. It lets you structure reimbursement in a way that actually fits your team, without the tax waste of a traditional allowance. One thing to know though, it's not your only mileage reimbursement option. If you want to learn about another mileage reimbursement approach, come with me to the next video where I'm covering fixed and variable rate reimbursement, a more precise program that's designed to reflect the real cost of driving. See you there.